Something just happened in the silver market that most people didn't see coming. And if you're watching this video, you're likely already connected to this story in some way, either as someone who saw this possibility years ago, or as someone trying to understand what it means now that it's here. Silver has crossed $110 per ounce. That's not a typo, that's not a projection, that's the price. And while headlines are calling it a shock, a bubble, or a mania, the reality is far more complex and far more important than any single number can capture. This video is not about celebration. It's not about fear. It's about understanding. Because whether you hold silver or you don't, what's happening right now is telling us something critical about the financial system we all navigate. And if you ignore that signal, you're ignoring one of the most important shifts in market structure we've seen in decades. I'm not here to hype an asset or sell you a dream. I'm here to walk you through what changed, why it changed, and what it means for your financial decisions moving forward. This is a long conversation, but it's one worth having. Because the people who understand cycles, who understand debt, who understand monetary pressure, they're the ones who stay calm when everyone else is panicking or euphoric. So let's start at the beginning. Let's talk about what actually happened, and more importantly, why it happened now. For years, silver traded in a range that felt predictable. $20, $30, occasionally a spike to $40. The metal was useful, industrially vital, but financially overlooked. Gold got the attention. Bitcoin got the headlines. Silver sat quietly, doing what it does, serving as both a commodity and a monetary asset, never quite fitting into one category cleanly. But something shifted. The forces that were building beneath the surface for years finally surfaced. And when they did, the price didn't just move, it exploded. From $70 to $110 in a matter of weeks. Not months. Weeks. Now, before we dive into why, let's establish something important. This move wasn't random. It wasn't driven by a single tweet, a single fund, or a single event. It was the result of multiple pressures converging at the same time. Structural pressures, supply pressures, monetary pressures, the kind of forces that don't reverse overnight because they're rooted in decades of policy decisions, not days of market sentiment. The first pressure is supply. Silver is consumed. Unlike gold, which sits in vaults and gets recycled endlessly, silver gets used up. It goes into solar panels, electronics, batteries, medical devices, and once it's used, it's often gone. The above-ground stockpiles that existed 20 years ago have been drawn down. Mining output hasn't kept pace with industrial demand, and the easy-to-access deposits are largely exhausted. This isn't speculation. This is geology and economics. When you consume more of something than you produce, and you do that for years, you eventually run into a shortage. The market ignored this for a long time because financial demand was low, but that changed. The second pressure is monetary. Central banks around the world have been expanding their balance sheets for over a decade. Quantitative easing, stimulus, debt monetization. Whatever term you prefer, the outcome is the same. More currency units chasing the same or fewer goods and assets. That creates inflation, not just in consumer prices, but in asset prices. And when people lose confidence in the stability of currency, they look for alternatives. Gold saw this first. Central banks have been buying gold aggressively since 2022, but gold is expensive per ounce, difficult to transact in smaller amounts, and increasingly concentrated in the hands of institutions. Silver, by contrast, is accessible. It's affordable in single-ounce increments. It has industrial utility and monetary history. And for the first time in years, retail and institutional investors started noticing that gap. The third pressure is structural. The silver market is small, far smaller than people realize. The entire above-ground investable supply of silver, coins, bars, allocated accounts, is worth a fraction of the daily trading volume in major stock indices. When capital flows into a small market, prices move violently. And once that movement starts, it attracts more attention, which attracts more capital, which amplifies the move. This isn't a pump and dump. This is what happens when a legitimately tight market meets a legitimately large wave of demand. The price doesn't just rise, it gaps, it shocks, it forces people to reevaluate their assumptions. The default reaction to a price move like this is disbelief. People see $110 silver and immediately think bubble. They think irrationality. They think it can't last. And in some cases, they're conditioned to think that way because they've been told for years that precious metals are relics, that they don't produce income, that they're for doomsday preppers and conspiracy theorists. But that narrative misses the point. Silver isn't rising because of a fad. It's rising because the conditions that suppressed its price for years are reversing, and those conditions were never natural. They were the result of policy choices, financial engineering, and a global system built on the assumption that debt could expand forever without consequence. Let's talk about that assumption. For the last 40 years, the financial system has operated on the principle that central banks can manage growth, control inflation, and smooth out cycles through interest rate policy and money creation. And for a long time, it worked. Inflation stayed low, markets stayed calm, debt stayed cheap, but that era is ending. Not because of a single policy mistake, but because the math no longer works. Debt levels across developed economies are at historic highs. Interest payments on that debt are consuming larger portions of government budgets, and the tools that central banks use to stabilize the system, rate cuts, bond purchases, are either exhausted or politically unacceptable. When you're in that environment, hard assets start to matter again, not because they're magical, not because they're guaranteed to go up, but because they're finite. They can't be printed. They can't be diluted. And in a world where currency is losing purchasing power, that matters. Most people don't think this way. They think in terms of stocks and bonds. They think in terms of quarterly earnings and Fed announcements. And there's nothing wrong with that until the rules change, until the system that rewarded financial assets over real assets starts to crack. Silver hitting $110 is a symptom of that crack. It's a signal that investors are starting to price in a different kind of risk. Not the risk of a recession, not the risk of a market correction. The risk that the currency itself is less stable than we've been led to believe. This isn't the first time we've seen this pattern. History doesn't repeat, but it rhymes. And if you look at past cycles where monetary pressure met supply constraints, you see a familiar sequence. First, denial. The asset rises and people dismiss it. They call it a fluke. They say it's overvalued. They wait for the pullback. But the pullback doesn't come, or when it does, it's shallow. The asset finds support at levels that seemed impossible months earlier. Second, recognition. Analysts start to notice. Media starts to cover it. The narrative shifts from "this is irrational" to "maybe there's something here." That's when the second wave of buyers enters. Not the early adopters, but the professionals. The funds, the allocators who need a thesis but also need permission from their peers. Third, acceleration. Once the narrative is established, momentum builds. Retail investors see the move on their screens. Institutional investors see flows into related ETFs and futures. And the feedback loop intensifies. Prices rise not just because of fundamentals, but because rising prices validate the fundamentals. We saw this in gold from 2019 to 2020. We saw it in oil in 2007 to 2008. We saw it in Bitcoin in 2020 to 2021. And we're seeing it now in silver. But here's what most people miss. The acceleration phase doesn't last forever. At some point, the move exhausts itself, either because supply finally responds, or because demand pulls back, or because the macroeconomic backdrop shifts. And when that happens, prices correct, sometimes violently. Does that mean silver at $110 is a top? No. Does it mean it's going higher? Also, no. What it means is that we're in the middle of a cycle, not the end. And the people who survive cycles are the ones who understand that price is information, not prophecy. Right now, the information is clear. Demand is overwhelming supply. Investors are repositioning for a world where currency stability is questioned, and the market is repricing an asset that was undervalued for structural reasons, not fundamental ones. How long does this last? That depends on factors we can't control. Central bank policy, geopolitical stability, industrial demand, investor sentiment. But the pattern suggests we're not at the end. We're somewhere in the middle, and that's both an opportunity and a risk. If you've been holding silver for years, watching it sit at $25, then $30, then $50, you're probably feeling a mix of vindication and uncertainty. Vindication because your thesis was correct. Uncertainty because now you're facing a question you didn't have to face before. What do I do now? The first thing to understand is that you were right for the right reasons. You recognize that silver was mispriced. You recognize that monetary policy was unsustainable. You recognize that industrial demand was growing while supply was stagnant. And you had the discipline to hold through years of sideways price action and skepticism from people who thought you were wrong. That discipline matters now more than ever, because the temptation at this stage is to do something, to sell, to buy more, to trade around the volatility, and for most people, that's a mistake. Here's why. When an asset moves this quickly, your emotions move with it. You start checking the price daily, hourly. You start imagining what happens if it hits $150, $200, or you start worrying that it's going to crash back to $60, and those emotions cloud your judgment. The investors who do well in these cycles are the ones who already decided their strategy before the move happened. They decided how much they were comfortable holding. They decided under what conditions they would reduce exposure. They decided that the asset was part of a long-term allocation, not a short-term trade. If you didn't have that plan before, now's the time to create one. Not based on where the price might go, but based on what role this asset plays in your financial life. Is it insurance? Is it speculation? Is it a store of value you plan to hold for decades? The answer to that question determines what you do next. If it's insurance, you hold. You don't sell insurance when the fire starts. You hold it because that's when it matters most. If it's speculation, you take profits. You reduce exposure into strength and preserve capital. If it's a store of value, you rebalance. You trim the position if it's grown too large relative to your portfolio, and you reallocate to maintain balance. None of those strategies are wrong. They're just different. And the mistake is not having a strategy at all or changing your strategy based on how you feel today. The second thing to understand is that volatility is normal now. Silver at $110 didn't get there in a straight line, and it won't stay there without fluctuation. There will be days when it drops $10. There will be weeks when it rallies $20. That's not a breakdown. That's not a signal. That's just what happens when a small market absorbs large flows. If you can't handle that volatility emotionally, that's a sign you're overexposed. Not financially overexposed, emotionally overexposed. And emotional overexposure leads to bad decisions. It leads to selling at the bottom of a correction and buying back at the top of a rally. It leads to stress, second guessing, and regret. The solution isn't to ignore the price. It's to accept that volatility is part of the asset and to position yourself in a way where that volatility doesn't force you to act. That might mean holding less. It might mean holding in a way where you're not tempted to check the price daily. It might mean accepting that some gains will be given back in the short term in exchange for long-term exposure to a secular trend. Finally, recognize that this move changes the landscape. Silver at $110 is not the same asset as silver at $25. It's more visible, it's more volatile, it's more likely to attract speculation, regulation, and media attention. That creates opportunities, but it also creates noise. And your job is to filter the noise and stay focused on what matters: the fundamentals, the macro environment, and your own risk tolerance. If you're watching this move from the sidelines, you're probably asking yourself one question: is it too late? That's the wrong question. The right question is, what am I trying to achieve, and does this asset help me achieve it? Let's start with what silver is and isn't. It isn't a get-rich-quick scheme. It isn't a guaranteed way to double your money in 6 months. It isn't a replacement for a diversified portfolio or a financial plan. What it is a hedge, a store of value, a way to hold purchasing power in an environment where currency is losing value. If that sounds boring, good. Boring is what you want from a hedge. You don't want excitement. You want stability over decades, not volatility over weeks. Now, the price is $110. Does that mean you should rush in? No. Does it mean you should avoid it entirely? Also no. What it means is that you need to think carefully about timing, sizing, and psychology. Timing first. When an asset has already moved significantly, the easy money is gone. The people who bought at $20, $30, $40, they captured the bulk of the move. If you're buying at $110, you're buying into a trend that's already established. That's not wrong, but it's not the same as buying early. It means your margin of safety is smaller. It means your risk of a correction is higher. And it means you need to be more disciplined about how much you allocate. Does that mean you wait for a pullback? Maybe. But understand that waiting for a pullback assumes there will be one. And in a market this tight, with this much momentum, pullbacks can be shallow. You might wait for a drop to $90 and watch it go to $130 instead. That's not a prediction, it's a risk. And you need to weigh that risk against the risk of not having any exposure at all. Sizing second. If you're entering now, position size matters more than price. A small position at $110 is less risky than a large position at $90. Because the risk isn't just the price, it's how much capital you have at risk relative to your total portfolio. A 5% position in silver, even at an elevated price, is manageable. A 30% position is not. And if you're tempted to go large because you're afraid of missing out, that's a red flag. That's emotion, not strategy. Start small, test the waters, see how you react to the volatility. See if you can hold through a 10% correction without panicking. And if you can, if the position makes sense within your broader financial plan, then you can add over time. But adding over time means buying into weakness, not strength. It means scaling in when others are selling, not when everyone is buying. Psychology. Third, the biggest risk for someone entering now isn't the price, it's your own mind. If you buy at $110 and it drops to $95, how will you react? Will you hold? Will you sell? Will you panic? If you don't know the answer to that question, you're not ready to buy. The investors who succeed in volatile markets are the ones who control their emotions. They don't check the price every day. They don't react to headlines. They don't let fear or greed drive their decisions. They set a plan, execute the plan, and trust the process. If you can't do that, if you know that seeing a 15% drawdown will keep you up at night, then either size down or stay out. There's no shame in that. Investing isn't about being in every opportunity. It's about being in the opportunities that fit your temperament, your time horizon, and your goals. Let's talk about what not to do, because this is where most people lose money. Not because they're dumb, not because they're uninformed, but because they let emotion override logic. First, do not chase. If you see silver at $110 and feel an overwhelming urge to buy immediately because you're afraid it's going to $150 tomorrow, stop. That's not analysis. That's fear of missing out. And FOMO is one of the most expensive emotions in investing. And the assets that go up the fastest are also the ones that correct the hardest. And if you're buying at the peak of a parabolic move, you're setting yourself up to be the exit liquidity for people who bought earlier. Second, do not over-leverage. This is critical. Silver is volatile. If you buy on margin, if you use options, if you borrow to invest, you're amplifying that volatility. And in a market that can swing 10% in a day, leverage doesn't just increase your upside, it increases your risk of getting wiped out. I've seen it happen. I've seen people who were right about the direction of the move, but wrong about the magnitude of the swings, and they lost everything because they couldn't handle the volatility. If you can't afford to buy it with cash, you can't afford to buy it. Period. This isn't a trade. This is a long-term position. And long-term positions should never be funded with short-term debt. Third, do not follow the hype. Right now, every corner of the internet is talking about silver. Forums, social media, YouTube, podcasts, and a lot of what you're hearing is noise. People making predictions, people calling for $200, $300, $500 silver, people telling you to go all in, to liquidate your retirement accounts, to bet everything on this one move. Ignore them. Not because they're wrong, some of them might be right, but because following hype is a strategy that works until it doesn't. And when it doesn't, you're the one holding the bag. The people making those predictions aren't managing your money. They're not responsible for your financial security. You are. And your job is to think independently, not to outsource your decisions to people with unknown motives and unknown track records. Fourth, do not panic sell. This applies whether you already hold silver or you're planning to buy. At some point, there will be a correction. It might be 10%, it might be 20%, it might be sharp and scary. And when it happens, the urge to sell will be overwhelming. You'll see headlines saying the bubble has popped. You'll see people on social media saying they called the top, and you'll wonder if you should have sold earlier. Don't do it. Corrections are normal, they're healthy, they're part of every bull market. And if you sell into a correction, you're locking in a loss and giving up your position just when the weak hands are shaken out and the next leg up begins. If you believed in the thesis at $110, you should believe in it at $95. And if you don't, then you never had a thesis. You had a guess. Fifth, do not ignore the rest of your financial life. Silver is part of a portfolio. It's not the portfolio. You still need cash. You still need income-producing assets. You still need diversification. And if you're putting so much into silver that you're neglecting your emergency fund, your retirement contributions, your debt management, then you're making a mistake that will cost you far more than any gain in silver could provide. Investing is about balance. And balance means resisting the urge to go all in on any single idea, no matter how compelling it seems. Let's take a step back and talk about what's happening psychologically in the market right now. Because understanding psychology is just as important as understanding fundamentals. When an asset moves this quickly, it creates a feedback loop. Early holders feel validated. They talk about it more. They share their gains. That attracts attention. New buyers enter. The price rises more. That validates the early holders even further. And the cycle continues. This is normal. This is how momentum works. But it's also how tops form. Because at some point, the pool of new buyers shrinks. At some point, everyone who was going to buy has bought. And when that happens, there's no one left to push the price higher. That's when the correction starts. Are we at that point now? I don't know. No one does. But recognizing the pattern helps you stay grounded. It helps you avoid the extremes of euphoria and despair. Because right now, some people are euphoric. They think silver is going to $200, $300, that this is the start of a generational move. And they might be right. But they might also be at the peak of the optimism cycle, where belief is strongest just before reality intrudes. On the other side, there are people who are despairing, people who didn't buy, who watched the move happen, who feel like they missed out. And that despair can lead to reckless decisions, buying at any price just to be part of the action, or staying out entirely and hoping for a crash so they can feel vindicated. Both extremes are dangerous. The truth is always somewhere in the middle. Silver is neither going to $0 nor going to $500. It's an asset responding to real forces, and those forces will evolve. The price will fluctuate, the narrative will shift, and the investors who survive are the ones who stay calm, who think in probabilities, and who accept uncertainty as part of the process. Let's zoom out. Because while silver hitting $110 is significant, it's not the story. It's a symptom of the story. And the story is about the financial system we've built over the last 50 years. That system is based on debt, government debt, corporate debt, consumer debt. And for decades, that debt was manageable because interest rates were falling. When rates fall, debt gets cheaper to service. You can borrow more without increasing your payment. You can refinance at lower rates. You can keep the system growing. But rates aren't falling anymore. They're rising, or at best, they're stuck at levels that make debt expensive. And when debt is expensive, the math changes. Governments can't afford to service their obligations without printing money. Corporations can't afford to roll over their bonds without cutting costs. Consumers can't afford to maintain their lifestyles without going deeper into debt. This creates a choice. Either you tighten, cut spending, raise taxes, accept a recession, or you loosen. You print money, you inflate away the debt, you devalue the currency. And historically, when governments face that choice, they choose inflation, because inflation is politically easier than austerity. You can blame it on external factors, you can spread the pain across the entire population, and you can avoid the immediate consequences of default. But inflation has consequences too. It erodes purchasing power, it punishes savers, and it drives people toward assets that hold value when currency doesn't. That's gold, that's silver, that's real estate, commodities, Bitcoin, anything that can't be printed. Silver at $110 is a signal that investors are starting to price in that inflationary future. Not hyperinflation, not collapse, but a steady, persistent erosion of currency value that makes hard assets more attractive than financial assets. Is that future guaranteed? No. Central banks could change course. Governments could cut spending. Productivity could surge and offset the effects of money printing. But those outcomes require political will, structural reform, and a willingness to accept short-term pain for long-term stability. And right now, there's little evidence that any of those things are happening. So the market is pricing in the more likely scenario. The scenario where debt continues to grow, where central banks continue to intervene, and where the currency continues to lose value. And in that scenario, silver isn't overvalued at $110. It's repricing to reflect a new reality. Let's talk about how to think about this situation in terms of probability and risk. Because that's what disciplined investing is, managing probabilities and risks, not predicting outcomes. The probability that silver stays above $100 for the next year is unknown, but it's not zero, and it's not 100%. It's somewhere in between. And your job isn't to guess the exact probability. Your job is to position yourself so that you're okay regardless of which outcome happens. If you hold silver and it drops to $80, are you okay? If you don't hold silver and it goes to $150, are you okay? If your answer to either of those questions is no, then you need to adjust your position. Because you're not managing risk. You're gambling on an outcome. Risk management means accepting that you can't control the market. You can't control central banks. You can't control geopolitical events. All you can control is your own exposure, your own behavior, and your own emotional response to volatility. Long-term thinking means recognizing that this move, as dramatic as it feels, is just one chapter in a much longer story. Silver was around long before $110. It will be around long after. And the people who build wealth in markets are the ones who think in decades, not days. Does that mean you ignore short-term moves? No, it means you put them in context. A 20% correction feels devastating if you're thinking day to day. It's barely noticeable if you're thinking decade to decade. And your time horizon should determine your reaction. If you're a long-term holder, short-term volatility is noise. If you're a trader, short-term volatility is signal. Know which one you are and act accordingly. One of the most important things you can do right now is educate yourself. Not about silver specifically, but about how markets work, about cycles, about monetary policy, about history. Because the more you understand, the less you're vulnerable to panic, hype, or misinformation. Read books. Listen to people who have been through multiple cycles. Study past market manias and crashes. Learn about the mechanics of supply and demand, the role of central banks, the psychology of crowds. This isn't homework. This is self-defense. Because the financial world is complex, and complexity is where mistakes happen. Discipline is the other half. Education tells you what to do. Discipline is actually doing it, and discipline is hard. It's hard to hold when everyone is selling. It's hard to sell when everyone is buying. It's hard to stay patient when you feel like you're missing out. But discipline is what separates the investors who survive from the ones who don't. Discipline means sticking to your plan even when it feels wrong. It means rebalancing even when you don't want to. It means taking profits even when you think there's more upside. It means cutting losses even when you think it will come back. And most importantly, it means not letting emotion override logic. If you can develop that discipline, you'll do well. Not just in silver, in everything. Because markets reward discipline over time, even when they punish it in the short term. Silver at $110 is not the end of a story. It's not even the middle. It's a moment, a data point, a signal that something has changed in the way investors think about risk, value, and monetary stability. What happens next is uncertain. The price could go higher. It could correct. It could consolidate. All of those outcomes are possible, and none of them change the fundamental thesis. We're living through a period of monetary and economic transition, and hard assets are repricing to reflect that transition. Your job isn't to predict what happens next. Your job is to understand what's happening now, to position yourself appropriately for your own goals and risk tolerance, and to stay disciplined as the situation evolves. If you hold silver, you're not wrong. You're not a genius either. You made a decision based on a thesis, and the thesis is playing out. Stay humble, stay disciplined, and don't let short-term price action cloud your long-term judgment. If you don't hold silver, you're not behind. You're not missing out. You're making a different choice, and that choice might be right for you. But if you do decide to enter, do it thoughtfully. Do it with a plan. Do it in a way that you can sustain emotionally and financially, regardless of what the market does tomorrow. Above all, remember this. Investing is not about being right once. It's about being consistently rational over time. It's about understanding cycles, managing risk, and controlling your emotions. It's about staying informed without being overwhelmed. It's about thinking independently without ignoring reality. Silver hitting $110 is a moment. How you respond to that moment will define whether it's an opportunity or a lesson. Choose wisely, stay disciplined, and keep learning. Because the market doesn't care about your feelings. It doesn't reward hope or punish fear. It rewards preparation, patience, and clear thinking. And those are the qualities that will serve you, not just in this moment, but in every moment that follows. Thank you for watching. Stay informed, stay rational, and above all, stay calm.